Hello everybody, my name is Alesh Eisner and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record a video per week, so make sure you ring the notification bell to get notified each time one comes out. I received a question on YouTube about how much weight I put on different metrics when analyzing a stock. I've done another video that will help, but I also have a comprehensive course about stock analysis that will definitely tell you what I look at, including a cheat sheet. The course is at canadianmoneytalk.ca Advanced Investing Stock Analysis course. Let's note, first of all, that there is no perfect stock, because if there was nothing wrong with it, its price would be stratospheric, so I wouldn't buy it anyway. So you need to analyze what you're willing to put up with and what is a showstopper. Before I get into what mine are, I'll add a bonus tip about the approach of buy, hold, and sell since you mention it. I would argue that there is no hold. If you like a stock, buy it. If you don't like it, sell it. The fact that you have some of it already should not make a difference in its quality or your decision, since the trading commission shouldn't prevent you from selling. Look at every stock in your portfolio every day as if you didn't have it and ask, would I buy it today? If no, sell what you have, and if yes, buy more if you can. Now let's get into the metrics roughly in a sequence of priority. Number one, as far as what metrics I prioritize, the PE or price to earnings ratio is a very good indicator. I'm a value investor, so I like stuff that's cheap. PE of 10 to 20 is where I live. Single digits make me wonder if there's something wrong, and then I have to look more carefully. And I'm okay with 21 to 39 for what I consider growth stocks, but I wouldn't take anything beyond that. And I sold a stock when it got into the 40s from the 20s. This references back to the buy or sell discussion since it didn't match my metrics to buy, so I sold it. The PE is very dependent on the industry though. I also avoid anything with no PE or negative PE since they are not profitable, but might excuse the company temporarily if they have positive cash flow at least. The price to earnings ratio should definitely be under the index or the market average. The PE shows how much I am paying for a dollar of the company's profits, the earnings, and I don't want to pay too much. When you are paying in the high double digits or triple digits for the company, it is trading on sentiment as people piled in on the next big thing. There's high expectations of future profits, and things will end badly most of the time. Secondly, price to book or PB is another metric that depends on the sector the company is in, but I like a PE of 1, 2, or 3 on the outside. But a PE under 1 is good for me since the company is technically worth more than I bought it for. As a value investor, value means cheap. Price to book might even be less than 1, meaning that if the company stopped its business today, its net assets per share should be worth more than the stock price, on paper at least. The price to book should be less than 1.5 under most circumstances. A low PB value suggests the company is undervalued and you could be getting into a great company at a discount. Thirdly, for dividend payers, for financial sector companies, I look at the payout ratio of about 40 to 60%. The payout ratio is the percent of earnings needed to support the dividend. In theory, at a 50% payout, the company's earnings could fall by half and still cover the dividend. This is an extreme. But by limiting ourselves to payout ratio of 60% or less, I feel safer at night knowing my income is reliable. For other companies with depreciating assets like utilities, whose cash flow or operating cash flow needs to cover the dividend twice, preferably 3 times, as far as I'm concerned. Ideally, I look for a 3% yield or more on the current share price in Canada and a 2% yield in dividends in the US because US companies pay less dividends as a group. The yield percentage is an indicator of financial health and stability, and they are able to pass profits on to the shareholder. As an owner, I expect to be paid since that is why I invested. Still with the dividends, the 5-year dividend growth should be more than zero, ideally 6 to 10% growth per year of the dividends, which adds up over the years. Keep in mind that I locked in my dividend yield at the time of purchase, and with a 10% dividend growth rate, the yield I had locked in at the time of purchase will have doubled in 7.2 years. Number 4, for all companies, I like sales and profits to be increasing if they make a profit, of course. Sales increasing but unprofitable indicates a growth company that's trying to get its act together. So I look for lower losses over time. Since most of my companies aren't growth companies, you won't get an increase in growth rate for a parabolic growth in sales and profits, but a linear growth would be great. Number 5 would be debt. So high debt, especially in the 2020 to 2024 timeframe, has been a red flag with the high interest rates. So I look for a debt to equity ratio to be under 1. But real estate investment trusts and utilities, since they borrow for everything, and banks, which carry debt, can be in the 2s. Anything over that means that more of their assets were purchased by borrowing than through investor money, which will be a burden if the interest rates are high. Low debt means better flexibility and options during bad times. And I don't want the company to rely on debt to have the other metrics and returns I'm looking for. The debt multiplies the profits and increases the return on equity, but drags on the company and creates greater risk. And number 6, I also want the company to be trading at less than its fair value or intrinsic value. There are different ways to determine this value, including discounted cash flow method. The intrinsic value can be defined as the price that an investor would be prepared to pay for the security if it were not listed on a public stock exchange. I find valuation and fair value difficult to calculate on companies that aren't profitable. If there's no profit, but revenue doubles in 4 years, what is it worth? Companies are in business to make a profit, and if they don't, then I would qualify it as a speculation. There's other metrics, but these are the top half dozen for me in roughly order. That's all very flexible though. A stock that is amazing, cheap, great future, but has a high PE because other people picked up on it and bid the price up would get some leeway on the PE, for example. If you have any requests on what you'd like me to cover in future videos, please put that in the comment section. If you'd like to get in touch, please reach out on any of these social media channels, and may you have a profitable day.